Topic: Financial statements. 6 subtopics. First, income statement. Second, balance sheet. Third, statement of cash flows. Fourth, statement of changes in equity. Fifth, notes and other disclosures. Sixth, management discussion and analysis. Financial statements. A set of financial statements is a structured representation of the financial performance and financial position of a business and how its financial position changed over time. It is the ultimate output of an accounting information system and has following 5 components. First, income statement. Second, balance sheet. Third, statement of cash flows. Fourth, statement of changes in equity. Fifth, notes and other disclosures. Financial statements are better understood in context of all other components of the financial statements. For example, a balance sheet will communicate more information if we have the related income statement and a statement of cash flows too. Following the time period principle, financial statements are prepared after a specified period, say a quarter, year, etc. Interim financial statements. Quarterly and semi-annual financial statements are called interim financial statements and are normally prepared in a condensed form. It means that the disclosures required in them are far less than those required in annual financial statements. Quarterly financial statements are normally unaudited, but semi-annual reports need to be at least reviewed by an auditor who is a qualified professional accountant authorized to attest the authenticity of financial statements. Annual financial statements. Financial statements prepared for a period of 1 year are called annual financial statements and are required to be audited by an auditor, a chartered accountant or a certified public accountant. Annual financial statements are normally published in an annual report, which also includes a director's report, also called management discussion and analysis, and an overview of the company, its operations and past performance. Income statement communicates the company's financial performance over the period, while a balance sheet communicates the company's financial position at a point of time. The statement of cash flows and a statement of changes in equity tells us about how the financial position changed over the period. Disclosure notes to financial statements cover such material information which is not appropriate to be communicated on the face of the main financial statements. Income statement. Income statement, also referred to as a statement of income and expense, or B, statement of profit or loss, or C, profit and loss account, is a financial statement that summarizes the results of a company's operations for a period. It presents a picture of a company's revenues, expenses, gains, losses, net income and earnings per share (EPS), together with balance sheet, statement of cash flows and statement of changes in shareholders' equity. Income statement forms a complete set of financial statements. A typical income statement is in report form. The header identifies the company, the statement and the period to which the statement relates, the reporting currency and the level of rounding off. The header is followed by revenue and cost of goods sold and calculation of gross profit. Further down the statement there is detail of operating expenses, non-operating expenses, and taxes, and eventually the statement presents net income, differentiating between income earned from continuing operations and total net income. In case of a consolidated income statement, a distribution of net income between the equity holders of a parent and non-controlling interest holders is also presented. The statement normally ends with a presentation of earnings per share, both basic and diluted. Important line items such as revenue, cost of sales, etc. are cross-referred to the relevant detailed schedules and notes. Types. There are 2 types of income statements: single-step income statement, in which there are no subtotals such as gross profit, operating income, earnings before taxes, etc. and multi-step income statement, in which similar expenses are grouped together and intermediate figures such as gross profit, operating income, EBIT, etc. are calculated. Another classification of income statement depends on whether the expenses are grouped by their nature or function. Income statement by nature classifies expenses according to their nature, i.e., without allocating them to different business activities, while income statement by function classifies expenses according to the business operations that they support. For example, income statement by nature shows line items such as salaries, depreciation, a rent, etc., while income statement by function allocates salaries, depreciation, a rent, etc. between cost of goods sold, selling expense, general and admin expenses, etc. Components. Following are key line items that appear on a typical income statement. First, revenue represents the amount earned by the company in exchange of goods it supplied and services it provided. When there are few sources of revenue, a breakup may appear on the face of the income statement, otherwise, a separate note provides a complete picture. Second, cost of sales represents the cost of goods sold and services provided. It includes all such costs that can be traced or assigned to goods sold or services provided. Examples include raw materials, salaries of factory or service shop employees, manufacturing facility rent, depreciation of manufacturing equipment, lease rentals on equipment used in manufacturing or service delivery, indirect materials needed for production, etc. Typically, a separate note provides a complete breakup of cost of sales. Third, gross profit equals revenue minus cost of sales. It represents the profit earned on the goods and services of the company before any selling, general and administrative expenses and finance costs are accounted for. Fourth, operating expenses mainly include selling and distribution expenses and general and administrative expenses. Examples include salary of the CEO, marketing expenses, office rent, salaries of administrative staff, fuel for delivery vehicles, etc. Fifth, operating profit, equivalent to earnings before interest and taxes, EBIT, equals gross profit minus operating expenses, as the name suggests. It is the profit after cost of sales and all operating expenses have been charged to revenue. It is before any adjustment for interest or investment income and interest expense and taxes. 6. Income from continuing operations equals EBIT minus taxes. It represents the net income, example after tax income, earned from business components that the company intends to own in the future. It excludes any income earned during the year from business components that are treated as discontinued operations. Income from continuing operations provides a picture of the company's continuing earning capacity. 7. Income from discontinued operations is the after-tax income of business components which the company has disposed of during the year or has classified as held for sale at the year end. 8. Net income equals income from continued operations plus after-tax income from discontinued operations. A company's total net income includes income from both continued operations and discontinued operations. It represents the income earned during the year after accounting for all expenses. It is carried to statement of changes in shareholders' equity where it is added to opening balance of the retained earnings component of equity. 9. Distribution of income. A consolidated income statement provides a statement of how the income is distributed between parent and minority shareholders. 10. Earnings per share, EPS, is a critical part of income statement for companies that are required to calculate and present their EPS, mainly companies listed on a stock exchange. Both basic EPS and diluted EPS are reported. where basic EPS equals net income minus preferred dividends divided by weighted average number of common shares. Statement of cash flows. A statement of cash flows is a financial statement which summarizes cash transactions of a business during a given accounting period and classifies them under three heads, namely, cash flows from operating, investing and financing activities. It shows how cash moved during the period by indicating whether a particular line item is a cash inflow or a cash outflow. The term cash as used in the statement of cash flows refers to both cash and cash equivalents. Cash flow statement provides relevant information in assessing a company's liquidity, quality of earnings and solvency. Sections. As stated above, a statement of cash flows comprises of three sections. First, cash flows from operating activities. This section includes cash flows from the principal revenue generation activities such as sale and purchase of goods and services. Cash flows from operating activities can be computed using two methods. One is the direct method and the other indirect method. Second, cash flows from investing activities. Cash flows from investing activities are cash inflows and outflows related to activities that are intended to generate income and cash flows in future. This includes cash inflows and outflows from sale and purchase of long-term assets. Third, cash flows from financing activities. Cash flows from financing activities are the cash flows related to transactions with stockholders and creditors such as issuance of share capital, purchase of treasury stock, dividend payments, etc. Statement of changes in equity. A statement of changes in shareholders' equity is a financial statement that presents a summary of the changes in shareholders' equity accounts over the reporting period. It reconciles the opening balances of equity accounts with their closing balances. There are two types of changes in shareholders' equity. Changes that originate from transactions with shareholders such as issue of new shares, payment of dividends, etc. And B. Changes that result from changes in total comprehensive income, such as net income for the period, revaluation of fixed assets, changes in fair value of available for sale investments, etc. Components. Typically, a statement of shareholders' equity summaries changes in the following equity components. First, common stock, which represents the legal capital of the company and it equals the product of shares issued and the stated value of each share. Second, additional paid-up capital, also called share premium, which is the excess of paid-up capital over the legal capital. Additional paid-up capital equals issue price minus stated price times total number of shares issued. Third, treasury stock, which represents the value of shares repurchased by the company. It is a contra account to the paid-up capital. Fourth, capital reserves. Fifth, retained earnings, accumulated earnings since the start of the company net of dividends paid or any restatement adjustments. Sixth, gains and losses on cash flow hedge, unrealized portion of change in fair value. Seventh, gains and losses on available for sale securities, i.e. the unrealized portion of change in fair value. Eighth, revaluation surplus represents the effect of revaluation of fixed assets. Following are the most common changes in shareholders' equity. First, issue of new share capital. It increases the common stock and additional paid-up capital component. Second, net income loss for the period. It decreases retained earnings. Third, payment of cash dividends. It decreases retained earnings. Fourth, purchase of treasury stock. It increases treasury stock component and eventually decreases total net shareholders' equity. Fifth, sale of treasury stock. It decreases treasury stock component and affects retained earnings and additional paid-up capital, and ultimately increases total shareholders' equity. 6. Issue of bonus shares. Affects common stock, additional paid-up capital and retained earnings. 7. Revaluation of fixed assets. Increases revaluation surplus. 8. Reversal of revaluation of fixed assets. May decrease revaluation surplus. 9. Effect of foreign exchange translation. Decrease in foreign exchange reserve. 10. Effect of changes in value of available for sale securities. Increase or decrease in available for sale securities reserve. 11. Restatement of financial statements, for example due to change in accounting principle, changes in retained earnings. Notes and disclosures. Notes to the financial statement present all such information which cannot be presented on the face of income statement, balance sheet, statement of cash flows and statement of changes in equity. Typical notes to the financial statement are: first, an introduction of the business outlining its legal status, its country of incorporation and the name of its parents if any, in a statement about the company's areas of business and its operations. Second, a summary of accounting policies related to revenue recognition, inventories, property, plant and equipment, financial instruments, etc. Third, a schedule of property, plant and equipment showing the addition and deletion of assets, related movement in the accumulated depreciation account and book value. Fourth, a breakup of cost of sales, selling expenses and administrative expenses. Fifth, a detailed disclosure of different classes of financial instruments and their related risks. Sixth, a breakup of the gross amounts and present values of lease obligations of the business. 7. A detail of transactions with related parties. 8. A detail of contingencies that may affect the business in future, for example legal proceedings against the business. 9. A description of major events that occurred after the balance sheet date, etc. Management discussion and analysis. Management discussion and analysis (MDA) is an unaudited section of an annual report in which the management discusses the company's financial performance for the past period and its current financial position and provides insight into the company's future prospects in light of its strategy. Additionally, it discloses its basis for critical accounting estimates. Management discussion and analysis (MDA) is a term normally used by companies in the US. Directors' report is the UK, and to some extent international, equivalent of MDA. Audited financial statements and accompanying notes are standardized representation of the company's performance and its financial position, which does not allow the management to have their say. MDA fills this gap by giving them an opportunity to justify the performance and communicate what they plan to do in future. The flexibility which MDA allows in communicating plans about future makes it a very important section for the company's stakeholders. However, it ought to be used with caution because the unaudited forward-looking statements of the management might be too optimistic.